We're going to cover 10 top tips for property investors for finance in 2025. Of course, you realise the information that we're giving you is general information, and we can't really tell you in specific advice. And don't take a piece of advice, run off and implement it, and then say, well, Louise said that should apply to me. No, I didn't. It's definitely general. So tip number one, we're talking about interest rates. So what are the expectations for interest rates? What do you think your expectations are for interest rates this year? Are we going down lots more? Are we holding at this level? So the experts are saying they don't expect them to go very much lower. Many experts suggest that only a total of 0.5 this year. And now savings from COVID are gone because people were well in front in their offset accounts for the last few years, and that has all gone. And now when push comes to shove, they're in a world of pain. And there's a lot of people out there who are suffering, and they're thinking this is going to be the start of many. It won't make that much difference. If you're not managing now, you already need some help. So this was an interesting chart that John Lindemann sent out, was talking about standard home loan rates and Sydney house price movements. And he was talking about how you can see the green circles indicate where interest rates came down and what then happened to house prices. And although the expectations is, well, interest rates come down and then, you know, house prices will rocket up. But he told us that it had to have a lot more interest rate cuts before we got the uplift. So it wasn't just one, it was 1, 2, 3, 4, 5 before you got any uplift. So quite a significant drops in interest rates before we got this uplift in prices. So if you're thinking, I'm waiting until prices get up, or I'm going to sell when prices are going up and then I'll move things along, you might need to wait a bit longer. So you might need to be a little cautious on that, and hopefully, well, we'll see what happens. So that's just a discussion on interest rates. No one knows, not even the RBA, but certainly bank economists don't. We're all just doing our best guess and your guess is as good as any others. I can tell you, it's amazing. But you might have a feel for it, and what you hear and what you talk to people about is probably spot on. Tip number 2, fixed rates versus variable. Some of the fixed rates at the moment might be worth a look. Some of them are at least a 0.45 below the standard variable rate. So in the expectation that rates are not reducing that dramatically over the next year, you might think, well, I might fix for 1 year, maybe 2, and have a look at that and just lock in some surety at a lower level. So there's some quite reasonable rates in the 5s, whereas we've been in the 6s up until now. Now, what are you asking there? Is a lower fixed rate with lower rate with principal interest is better than a normal rate but interest only loan? Can be, that would be usually the case. Interest only loans are generally more expensive, definitely. So if you want us to review, just call us. One of the things that's been happening lately, big news in the market, has been multiple offset accounts. So tip number 3, multiple offset accounts are now being offered by 2 of the major lenders. None of them have been doing it, only CBA for years and years, and the others were not doing it. And about 10 minor lenders were using them. You know, the Suncorps, Auswide, but lots of lenders don't, so it's not a standard thing. However, both NAB and Westpac have come out in the last week and said they're now offering multiple offset accounts. So why would you want multiple offset accounts? So you can split up your money, like people have often seen the Barefoot Investor describe how to put your money into, and lots of people manage their money this way. And it's great to be able to offset the interest in your home loan. So, which means you're getting around 6 or 5.5% around at the moment, high 5s, 6s on your interest, which is a lot better than actually having it in a savings account, getting interest paid to you and then paying tax on that. So this is a much better use of your money, or it can be. But Leah, we were talking before, and I'd love your comments on this, if you can, to talk about the effect and what people do about debt recycling. And some people talk about what you can use offset accounts for and where you put your money on your loan. So as an expert tax advisor, go for it.
Well, I think the multiple offset accounts, the Barefoot Investor is definitely one that as accountants we don't often like, because people like to have these daily transaction emergency fund travel funds. And without the multiple offset account against your home loan, even though you might have been getting a great 5% rate, you are still out of pocket, because people always say, oh, but I can get the same rate putting money into, well, they could up until probably rates changed. And it just doesn't work tax-wise. So having multiple offsets when you have what we call bad debt, home loan debt, is a great way to manage that bare footprint. Whereas for us, what I love is loan splits. I guess the takeaway from multiple offsets is we always want to offset our home loan, and then what we want to be able to do is then flick that. Once we're totally offsetting our home loan, then that's the only time we would offset our deductible debt, is when we're fully offset.
And we do find that people do get confused about that. And sometimes it's good to run an offset account for your investment properties, but you can run an offset account against your own home loan. But you can have all your rents going into one offset account. So say in retirement fund, but that can be your rent income and expenses account. It can be paying off to the loan, but actually still offsetting your home. So you can use that to actually pay the investment loans, but it can still be offsetting your home loan. So that can be very useful. So I would highly recommend, if you haven't got that sort of structure set up, do contact us and we can help you, because they are really, really useful. Tip number 4. Less interest only means more borrowing power. One of the things I find, people sometimes will go to their banks and say, oh, I asked for a 5-year interest only loan because my accountant said that's what I should get for a property investment, and the banks have said no. And the reason why might be simply because of the borrowing your serviceability. And you might have got an interest only loan for 2 years rather than 5. So the thing, just some of the advantages and disadvantages of the different loans types, I'm telling you here. So the advantages of a principal and interest loan are now that they are lower interest rates. Now, for many years, this was not the case. They used to be all the same, and then the banks were told they could make more money on interest only, so they raised those rates. And now one of the most expensive home loan interest only loans is for owner occupied purposes. They actually will give an investment rate cheaper for interest only than they will on owner occ. Now, why is that? Because they don't want owner occupiers buying a house with interest only loans. They want them paying them off. And that's why they're pricing them so much higher, so they to put you off actually getting one of those loans. So an interest only loan, you can use an offset, and it actually reduces the repayment because you're not paying any interest if you've got it fully offset. And so you can hold your money there for a good period and no problem. And whereas a principal and interest loan, if you're using an offset account, there's very few loans that actually change the repayment. So what happens is, say you're paying $2,500 a month on your mortgage, you've got $400,000 loan, you've got $100,000 in your offset, you're still paying the same $2,500 every month with most loans. There's very few that actually reduce the repayment despite you having the $100,000 there. So why is that? Well, they actually just applying more of the same repayment to the principal. So it actually means your loan goes down. So that's a bonus if you can cope. And one of the things you can do with rates reducing like they will be in the next few weeks, is say to your lender, maintain my repayment at what it was, because I was already coping with that. And that means you're actually paying more principal off your loan, and you'll reduce it quicker. Some of the disadvantages of principal interest loans: the cash flow affected due to the higher repayments, and once you've paid it down, no longer tax deductible. And I think that was one of our things, Leah, we were talking about. People sometimes, often first home buyers will smash down the debt on their first home and then go to buy a new home, and they want to turn that initial unit or apartment that they bought into an investment, but they've got no longer any debt. So it's no longer tax deductible. And they say, oh, but I can just re-borrow and use it to buy the next place. Yes, you can borrow, but it doesn't make that debt tax deductible.
No, and that's the plan. That's the plan at the start, is to have your mortgage and have your offset account, and think about whatever is in your offset account, do the math and go, yep, my home loan is only $50,000 or $40,000 rather than whatever else it is on statement, because the minute you redraw on your loan, yes, you can do it, but technically that money has been used to go and buy your home, so therefore the interest isn't deductible. And that rule has been around since ever, but nothing has changed from an ATO perspective. It's just that people have done it and they've got away with it. It doesn't necessarily mean it's right. So by using that money in the offset account to go and buy your next home means that the interest goes up on the investment that is now the unit, and therefore we can actually claim the full interest.
Super. Yeah. And on interest-only loans, often what we do for people who've got quite a few in their portfolio, every 5 years we'll refinance them to get them another 5 years interest only, because it's harder to service a loan if the second lot of 5 years, sometimes they used to be, the banks said you'd call them up and they'd just extend your interest only period. But ASIC and NAPA have got a bit excited about people never paying off their debt. So they've insisted that you now be reassessed. And if you can't afford it, then you're stuck with all these properties and loans that you don't want to really pay principal and interest on. So it's good to have that in mind. And before you need it, let's start working on what you've got to do about this. So we always keep you a buffer in the system. It's good to get a loan that has room in it, if you've got equity, to give you some buffer room so you can pay extra things like this. Just note, interest only definitely reduces your borrowing capacity, because if you've got a 5-year interest only, when they assess you, they're saying, well, you're not paying that loan over 30 years, you're paying it over 25 or 20. And so that means that you can't afford necessarily to pay it back over that shorter period of time. And as such, then we're not going to lend you as much. And if that's the case, well, then we've got to find another way around it. And that's how I say, well, we can reduce your interest only period or do other things. And also, you may not get an increase in your equity if the property doesn't grow. And that was the thing with people getting lines of credit, etc. So now there's a question. Is there a question? No, you can refinance whenever you like, every year if you wanted to, but at the same institution, it can be more difficult to get an interest-only loan repeated, to say. And if I'm not being specifically clear for you, please feel free to ring me after, and I'm happy to have a chat with you and go through these. So tip number 5 is how to service a loan. Some tips on this. One of the things I find that people often will tell me, oh, I've got to get a credit card. No, you don't. That's rule number 1. I'm on probation. Probation's fine. We have lots of lenders who will be happy to have you on 1 day in the job. Bonus usually must be 2 years, but then some lenders will now take it on less. Allowances fully can take it 80%. What was the other thing?
Overtime?
Yeah, overtime depends. We've got to have 6 months to show it's a regular thing. 6 months is usually the minimum. And now some lenders will take commission over 6 months, whereas previously they would say, oh no, you have to have a minimum of 12 months. But that's been reduced recently because obviously the lending environment's got harder for them. So they're trying to find ways to make it easier to lend to you. There used to be golden rule was an ABN, you had to have 2 years, but now sometimes they'll do a year and your BAS, most recent BAS. So there's all sorts of ways that you can get it. And we are inundated every single day with lenders sending us updates on this information. It is almost impossible to keep up. And I have a whole team in the background sourcing and researching this information for us all the time. And that is why we're able to offer the service we do. But what I'd say to you is if you think you know your lending, it can change. It changes all the time, every single day. The rental income they use is usually income per week divided by 7 multiplied by 365, and the max is usually they shave it to 80%, but some lenders will only even take 70% of rent from property investments. And then the big debate is, well, what do they charge for your property expenses? And that some charge 10%, some will charge exactly what's on your tax return. So we really loathe, if you're a property investor with multiple properties, we really try and avoid using a lender that you'll have to send your tax return to because they'll kill you on servicing. So you have to be really aware of that and be very careful about your expenses when you're coming up to a loan. Valuations can hurt borrowing through the loan to value ratio. So if your valuation comes in low, then it can make your borrowing harder and it can make your interest rates higher because they charge you a higher rate at 80% than 70% or 60%. Now, not all lenders, but a lot of them. So it's worth knowing, gosh, we really try hard to get higher valuations all the time so that you can get the lowest interest rate possible. And a recent change has been Airbnb income. Usually over 1 year in tax returns, it used to be. Sometimes they'd say, well, if you're not declaring it, it's not over there at all. We won't even count it. That was when it was a year or two ago. Then they were very conservative about it. But now they've seen it all come through and they're realising people are making a mozza out of these places sometimes. So now 3 months most recent credits for Airbnb in some lenders, not all, will be annualised to use income for servicing. So that's huge difference. And initially when they came out, they were shaving them to 50%. So they were really killing us. But now it's changed. So just be aware of that. Don't think you know the rules in the background. Things change.
How does a bank know that it's an Airbnb property as opposed to a long-term tenant?
Because they can see where we prove the income. So we have to show statements. So if you don't have a set rental statement to show where your rent's coming in, and they can also see it coming into your account.
Okay.
So it comes in different amounts. So they'll know instantly. And that they can see without us even telling them anything. The machine will tell them, I'm sure. Credit cards takes off plenty of your borrowing. 10,000 credit card can take off 40,000 in borrowing. It's not a dollar for dollar. People go, oh, it's only a credit card and I never use it. No, that has nothing to do with it. The credit cards count whether you're using them or not. If they're sitting in the drawer and you haven't used them in years, then still they need to be cut up and closed. And we need letters saying they're closed. Help debt is still a problem and they're all talking about it. Supposedly Treasury has been instructed, APRA and ASIC, to have a look at the rules around assessment for banks and help debt and can they change this so particularly first home buyers will be treated a bit better about it, which would be great. But we'll see, because they now count it as a debt against you. So that can be quite negative. Furniture loans, oh, just don't. I know people seem to take a loan out for anything and there's always some hidden fees. There's never nothing. There's always a fee. Even if they say, oh, there's no interest, there is always a fee. Zip pay and afterpay, try and avoid them if you can, because they all count against you in your servicing. Car loans. Now, people say, oh, but look, the bank gave me, I got his car loan so easily. I don't know why it's so hard to get a house. Well, interestingly enough, try and get your car loan after we've got the house is usually the advice. And companies you no longer use. So you might have a shelf company that you had in the past, you maybe traded and you never really use it anymore. Get your accountants to give you a letter saying it's not trading and has no tax or other liabilities. Some banks will just say, just tell me and I'll agree to that. Some insist on an accountant's letter. So we'll have to clarify which lender is asking for which policy. But that's one of the things, if you've got old companies that you're not using, then you might be asked about it. So make sure you tell your mortgage broker, oh, I'm actually a director on a company that I haven't used in years. So it's worth having that conversation. And some lenders are now counting investment expenses in the HEM, which is the HEM is the Housing Expenditure Index that they use to judge how much on your particular income you spend a month. So that's the minimum they will count against you in the assessment. So whenever people give us their living expenses for the month, people are either extremely high and wrong, and so they say, oh no, we spend much more, and then we'll assess them and they don't, or they generally always spend way less than the HEM, which is the average. And most people cannot survive on HEM or under, and they don't, but they just don't think they spent that much. So it's really interesting from us to watch. So the HEM is set by the government and all the banks then, it's reassessed every 3 months, I think, and they change the HEM consistently. And they've been changing it quite a lot due to all the increase in the investment expenses. So the property investment expenses that will count against you in an assessment, because that can be quite negative. So that's some of the things we just have to cover off every single day when we're looking to assess you and help you with a loan.
I just want to jump in quickly and mention one thing on investment expenses. When it does come to investment expenses, a lot of lenders will sometimes only even take 10% of the rental income. And it really depends on lender specific and what actually shows in your tax returns. So it's really important to have a great accountant doing updated tax returns for you. And we outline all the expenses because the banks will check. And sometimes, and we've had it in the past, and Louise and I have smacked our heads against the wall several times when the expenses for some investment properties are just so high and we sometimes struggle with servicing. So being very clear on your investment expenses is also really important.
Mm. And maybe planning that, because a lot of people will put through everything in his job, which the banks know, but anyway.
Just on those expenses, so things like depreciation, often the
Oh, we
banks,
can add back, that's not the issue.
yes, no. So if you think about a repair to a property, then often there are ways to accelerate depreciation. So
Mm.
if you actually look at something, and it might be that you had lots of little things that were under $300, so I get to write those off straight away. But if it goes to the tax return as a repair, then of course the bank's using it as an expense. Whereas if we put it in the depreciation report and we write it off because we can, depreciation is higher. You get the same net effect for your tax return. But if you're going to then finance the next year, depreciation will be added back.
Oh, that's a fabulous tip.
Yeah.
So, how to be a little more ruthless on your expenses when you're counting them in your tax returns for the year, and when you're reporting them to your accountant, because they might not know to ask you, put that 300, it's under $300. So, thanks, Leah. And you should be quite specific about it when you're recording for the year. Don't expect them to come chase you for every little dollar. That's your job. It's really hard. They can't be even knowing or checking what you've done on that. So it's good if you keep a record yourself. Tip number 6, to increase your borrowing power. So as I said, use less interest only years, close or reduce your credit cards, no open afterpay or zip pay, use a lender who uses repayments. So some lenders will assess you on what you're actually repaying for loan instead of using a buffer and the years left on the loan. So that makes a profound difference to how we can get a loan through. And some lenders who use this increase the borrowing power of clients enormously just by these rules, but you have to know where to go. Do not apply for lots of credit. It's really a good idea to keep a clean credit file without much on it.
Sorry, Louise, just on the credit file.
Yeah.
And I think it's also just important for people to, I guess, after all of the data breaches that we've had with Optus and Medibank, or if your house has got broken into or your car, to subscribe to Equifax and those credit agencies, even if you have to pay $100 for the year to get that report every month, so you can actually see if there are hits on your credit file, because it's up to us to actually get them removed if somebody has attempted a hit on your credit file. I'll use my partner as an example. Our house got broken into and they took his wallet, and then he had lots and lots of fraud happen on his credit file, and we had to work with every institution to get those hits removed, because if we went to a bank to refinance, there would be 10 hits and they're all knocked back. And every institution we called, they said, oh yeah, we knew it was fraud, but that's all they said. And I'm like, yes, but could you please remove it? And they're like, oh, well, you have to go through this process. So they still log it. They know it's fraud and they knock it back, but it's still a hit on your file. And we ended up having to lock his credit file so that nobody could do any inquiries on it. And I could only say that I was on top of it, and I would hate to think if I hadn't have been.
Thanks, Leah. Yes, we had a client who actually applied once. Equifax is a provider of credit files. So there's only a couple of major ones in Australia and in the world, really. Equifax and Illion, usually, and there's one other. So they are the major providers of credit reporting in this country. And so a young client came and we submitted his loan, and then the lender came back and said, oh, look, he's got an unpaid electricity bill and it's not the end of the world. But I said, oh, that doesn't sound like him. And yes, he was renting somewhere and blah, blah, blah. Anyway, we found out, of course, someone had stolen or used his driver's license, applied to rent somewhere, then not paid the electricity bill, and all of this fraud. He had to end up going to the police and reporting the fraud and all that sort of thing. So anyway, it is important, so important to keep your file clean. Help debt, you might need to repay it. So sometimes we will tell you, don't do any of that before, even don't reduce your credit cards and zip pays and that, or zip pays get rid of, but credit cards and help debt, let us assess you first before you need to do anything, because you might not need to, or we can do it as part of the loan process. And keep your loan to value ratio down lower for better interest rates, therefore more borrowing, because if you get a lower interest rate, then lower repayment, and it works well in your favour. So tip number 7, equity release versus lines of credit. Heaps of people come to us asking, oh, we've got to have a line of credit. And the problem with lines of credit a few years ago, they used to be great interest rates, but now a lot of lenders are not using them. So a line of credit is an interest-only loan for usually 25 years that you don't repay until the 25-year mark. And if you can't refinance, then you're in a bit of trouble. They're very definitely more expensive when servicing loans. There's only one lender really that I know who's got a rate. It's got a master facility with a line of credit, and that's AMP. All the rest of them are pretty well gone. They don't offer them anymore because ASIC advised they don't want people having lines of credit because they come 5 years later and they had repaid none of their home loan. Whereas an equity release, we can just get a standard variable loan, which is what Leah was talking about before. We'd have your home loan and then a second loan for the deposit, which is your equity release. And we can make that loan interest only. You can have an offset account. You're still not paying interest on what you don't use and only on what you do. You get 5 years interest only, and they're much cheaper when servicing. You can get those loans. Sometimes they're matching the owner-occ rate with that investment loan. So that's very useful. Yeah.
So accountants don't like lines of credit because you mix the purpose of money going in and money going out. So there is a spreadsheet, if someone is still using a line of credit, that we have on the Bantax website where we apportion personal and, say, investment loans up to, let's say, 5 or 6, but traditionally we don't like them for that reason because it washes the tax deductibility of your interest. Whereas loan splits, as an accountant, we love them because we can split up to 10 or more in terms of and quarantine all of that interest. So you go and buy a new car and you use your car for work deductible purposes and you split your mortgage off. You go and buy a new house for an investment, but you need to come up with that 20%. The equity is released and you do a loan split for the deposit. So then, of course, we're quarantining the interest on that loan. They just make everything work so much better. And it's less work for you and less work for an accountant if they're doing your tax return.
So it makes your tax accounting cheaper. So that's good too. So that's why we're into that sort of structuring. So just so you know. So which loan's the most expensive? Well, here's the thing. Lines of credit are usually in the 9s. Now, they really don't like them. SMSF, for self-managed super fund loans, you can get them as low as early 7s. But that, again, depends on, are you paying principal and interest, and is the loan to value ratio 70 or under? If it's 80, they tend to get a bit higher, and they certainly go up to the 9s. It all depends on the circumstances, but you can get quite cheap loans for self-managed super funds. Low doc loans, they're usually in the 7s at the moment. So that's prior to the rate cut. So they might start heading into the high 6s now. So they're usually about a percentage point above a full doc loan. Well, that's not that much. If you've had income which you haven't declared, like you can't declare for whatever reason, or you haven't done your tax returns, and you can use a low doc loan and you can still show you're making money, then they can be an alternative for you. And if you're self-employed, it's an access point to actually get money, get investing and make more money. Personal loans, they say they start around 6s and 7s, but usually they end up being 10, 12 and 14s. It all depends on the circumstances, but they're always highlighting, oh, it can be really cheap, but that'd be when you really don't need it and it's only $5,000 and it's whatever. That's not quite what they seem from the headlines that you might read. And bullet loans, this is a particular loan for renovators, which capitalizes the interest onto the actual loan. You declare your own income, but you do not have to service the loan, nor do we have to prove that you can service the loan. So these are ideal loans for renovators who like to move houses quite quickly. They're only a loan for 6 months to 2 years. They're not for a long-term hold. You might think, well, at the moment I can not prove servicing, so I'll get a bullet loan, I'll renovate the house, and then in 6 months' time I might have my tax returns done, and then I can afford to refinance the property into a conventional loan, and then I'll reduce my interest. But maybe you don't want to miss an opportunity, so that can be a loan for you. And it's great, you don't have to make repayments, and I don't think that's too bad. 9%, if you were private funding, it'd be 15%, so that's quite good. So tip number 9, positive reporting. I just want to warn you, lenders can possibly see all of your accounts and your ins and outs. So if you're heading off to McDonald's every day, or much worse, gambling, online betting, buying Tats Lotto tickets all the time, don't do those things. They can see them, particularly when you want to go and apply for funding. So be very wary about, they can already see without you saying anything. And if you're applying directly, usually what we do is we get your clients' information first. We check for all of that so we can see where we direct you, so you can go to a lender that's more sympathetic for your circumstances. That's really important, that you don't just go in anywhere blind. You think it's fine and they see something that can't be unseen, and that can cause you problems. So be aware of that. This is the guide to the credit report. They're watching if you're overdue, any late repayments, and see, it's after a grace period, but anytime you're late paying your loan, it's noted on your credit file and banks can see it. They know if it's closed or if it's not reported, or if you didn't pay or how late you are. So it's completely different now. And often they won't even ask us to send in bank statements because they can already see it all. So just note whatever you're doing on your files and have a look for the last 3 months. It's a really good exercise to go through for checking in your budget. mycreditfile.com.au is a place to go to get your report done. It's a really useful thing. The next thing, just a quick tip, do not get overdrawn on your accounts, on your savings accounts. People go, oh yeah, but I'm paid the next day and it really doesn't matter, the bank lets me do it. Yes, no. Banks know that if you're that sort of person, they're less likely to want to lend to you. So be very wary about that. And you'll often see people have these massive fees. And if they stop paying the fees and just paid things on time, then they would be well in front on money. So be very careful about that. They hate seeing you go into the red on things like that, and pay your bills on time. I love this little fella. You mean to tell me you don't know how to manage your money? I just adore him. You can feel like out of control with your money, but the bank will know instantly. Their AI is searching your accounts and can tell more about you than you would know, and they offer to tell you. And most people don't want to know. Just have a look to see what you're doing, and then you can change your behaviour to suit what we need for the application often. We've got a budget planner on our website at propertyed.com.au, and it's really simple, and it spits out a nice report that you can set up and look at, and it helps you work out in which categories, and these are the categories basically that the banks are looking at and asking for. And also go to asicmoneysmart.gov.au. Surprisingly, that is a terrific website and has a lot of really useful stuff on it and great fun. Just tip number 10, I wanted to talk to you about rent versus buy calculator. This is a lender's mortgage insurance calculator that showed people if they actually bought earlier and got into the market and paid LMI, they actually ended up way in front than those who waited and saved a deposit. So at the moment, first-time buyers have this huge advantage because the government is virtually paying your LMI for you. But even if you're buying for an investment property or something else, it's well worth saying, well, if I think that market's going to grow and get ahead, then I definitely want to make sure that, and you can tax it up, can't you, your LMI, Leah, over 5 years, can't you?
It's part of your borrowing expenses that get apportioned over either the life of the loan or 5 years,
Okay, great.
whichever is earlier.
Okay, perfect. So if you have paid LMI in a loan and you weren't aware, make sure you take it up with your accountant and let them know. And the budget planner was on our website under calculators, Tracy. And so that was 10 tips. Wow. But I've got a bonus tip. I've got a quick one. Ask your bank for late fees or any fees that are charged that you shouldn't. And so this is a really good stats. Late fees, 25% requested a late fee. Only 25% requested a late fee. And the reason is because people feel a bit embarrassed about it. But if you've only done it as a one-off, just ring them and ask for the fees back, because it looks better when I've got the statements and then I'm going for a loan for you. 22% received a late fee waiver. So 87% of those who asked. So, geez, it's worth asking. Go and ask them. Annual fees, 11% requested an annual fee waiver and 6% received it. So 50%. It's worth cracking it for 50%. And lower interest rate, only 19% requested. Well, we do that for every person in our portfolio. We request every 6 months. Banks don't like us much for doing that, but we have managed to achieve some fabulous rates for clients, which I'm really proud of. Claudia manages that area for us. And 13% received it. So that's 69% of those who asked. So it's so worthwhile. And the other thing is really worth noting, couples are twice as likely as single people to ask for a fee reduction, which is ridiculous. So single people get cracking, and the more you earn, the more likely you are to ask, and they need it less, but they're more conscious of their money and saving it. So please, how do you request? That's a great question. You ring the bank and say, I want a rate reduction or a fee reduction. Just ask them, and they might put you through the special department that is useful for that for you.